Gold just broke $4,207 an ounce. If you think this is just another market rally, you're missing the real story. This kind of price movement only happens when pressure deep inside the global financial system is about to blow. For weeks, central banks have been on a historic buying spree, snapping up over 1,000 tons of gold per year, the highest level in modern history. Now, this isn't accidental, random, or speculative. This is strategic. The very institutions that print our money are aggressively stockpiling the one asset that cannot be printed, manipulated, or defaulted on. You need to understand something most people never learn. Central banks don't buy gold because they're bullish on it. They buy gold because they don't trust each other, the system, or the dollar. And when the people in charge of global monetary stability start panic buying hard assets, that's not a green light. That is a blaring warning siren. Gold soaring past $4,207 isn't the start of a new rally. It's the confirmation that the old system is cracking. Another major red flag just went up. The Federal Reserve has quietly ended its quantitative tightening program. When the Fed stops shrinking its massive balance sheet, it's not because the economy is stable and healthy. It's because they know liquidity is drying up so fast that a major credit event could trigger a financial contagion, spreading from one bank to the next. The Fed is already setting the stage for rate cuts, not because inflation is defeated, but because they know our economy simply cannot survive at these high interest rates without something massive breaking. Think about it. Commercial real estate, regional banks, sovereign bond markets, or even consumer credit. Any one of them could be the first domino to fall. You're not supposed to see this level of emergency positioning unless something is dangerously wrong behind the scenes. And all of this is happening as U.S. national debt barrels past $36 trillion. To put that in perspective, the interest payments on our debt are now larger than our entire national defense budget. When a country starts paying more to service its debt than to protect itself militarily, you are not in a normal economic cycle. You're witnessing a system that is approaching its mathematical limits. This is precisely why, throughout history, gold reacts violently when trust evaporates. Look at the pattern. In 1933, the U.S. government confiscated private gold and revalued it higher to save the banking system because the dollar was collapsing. In 1971, President Nixon took the U.S. off the gold standard because foreign governments no longer trusted that their dollars were redeemable for gold. What happened? Gold soared again. And in 2008, after the global financial crisis, faith in the entire banking system vanished, and once again, gold shot upward. See the sequence? Trust collapses first. The price follows later. But what's happening today is different, and it's on a scale we've never seen before. The distrust isn't just limited to a few banks. It's hitting currencies, governments, and major institutions all across the globe, all at the same time. The dollar's dominance is weakening, not because it's a bad currency, but because the mountain of debt behind it has become unsustainable. As a result, countries around the world are diversifying away from it, shifting their reserves into gold and other hard commodities, because they can't risk being trapped in a system that has to print trillions of dollars just to stay afloat. And this is where the real story begins, the great global reserve shift. Recent data from the International Monetary Fund, the IMF, shows central banks are dumping their U.S. dollar holdings while increasing their gold reserves at the fastest pace in modern history. China, in particular, is stockpiling gold every single month without fail. The message they are sending couldn't be clearer. They are preparing for a future where the US dollar no longer dictates global trade. And when the world's major economies start building parallel systems, like gold-backed trade agreements, commodity-backed payment networks, and alternative currency blocks, that's not some wild conspiracy theory. That's the blueprint for a global monetary reset. This reset isn't going to be announced on the evening news. It happens through slow, deliberate, strategic moves made by countries that are losing trust in one dominant currency. Gold, surging past $4,207 an ounce, is the visible symptom of this silent tectonic shift. The average person looks at a chart and just sees a price, but the informed person sees a 5-alarm fire. You are watching the exact same conditions that triggered every major monetary reset in the past, but this time, it's on a global scale we've never witnessed. Multi-trillion-dollar debt spirals, declining trust in all fiat currencies, massive central bank gold accumulation, and geopolitical fragmentation. When complex systems approach their breaking points, hard assets historically become the anchor. It's not because gold is magical. It's because it's neutral, it's finite, it's borderless, and it is completely immune to counterparty risk, meaning its value doesn't depend on someone else's promise to pay. This is why, throughout 5,000 years of history during runaway inflation, currency devaluations, banking failures, and sovereign debt crises, gold has always been the asset of last resort. This isn't about speculation. It's about insurance against systemic failure. And right now, the price of that insurance is telling you that system stress is reaching critical levels. The trust collapse is happening in real time. We see it in rising inflation that persists despite the Fed's aggressive rate hikes. We see it in falling bond prices, which signal a lack of faith in government debt. We see it in our own wallets with weakening purchasing power. And we see it in the headlines as countries openly prepare for a world of non-dollar trade. The global economy is moving toward a point where the current system can no longer function without a fundamental restructuring. This isn't hype. This is all based on verifiable data, World Gold Council statistics, Federal Reserve balance sheet trends, U.S. Treasury debt records, and IMF reserve reports. The numbers themselves are telling the story. So, if you're watching this, I want you to leave a comment right now with your thoughts. This isn't just another market update. This is a moment in financial history. So, what happens next? And how is the smart money positioning itself before this reset hits? The first thing to understand is that a reset isn't a single event, but a process. It's already underway. Smart money isn't waiting for a crash. They're preparing for a transition. They are moving out of assets that are someone else's liability, like bonds and even cash held in a bank, and into assets that are nobody's liability. This means tangible physical assets like gold, silver, and other commodities. They understand that in a world of unlimited money printing, the only safe haven is in assets that are limited and real. The next stage will likely involve a crisis of confidence in government bonds. For decades, they've been considered the safest investment on Earth. But with debt levels spiraling out of control, that's changing. As more investors start to question whether they'll be paid back in currency that has any real value, they'll sell their bonds, which will force interest rates even higher, creating a death spiral for governments that are already drowning in debt. This is when the official narrative will shift. Governments and central banks will be forced to introduce new systems, perhaps even digital currencies, but these will likely be linked to a basket of commodities, with gold as a primary anchor, to restore trust. To prepare, you don't need to be a financial genius. You just need to follow the central bank's playbook. They are telling you, with their actions, what they believe the future of money looks like. They are preparing for a world with less trust in paper and more trust in physical assets. The average person is focused on stocks and crypto, chasing short-term gains. But the truly wealthy are playing a different game. They are focused on wealth preservation for the long term. They are buying insurance. The moves you make in the coming months could be some of the most important financial decisions of your lifetime. The signals are all here. The question is, are you paying attention? Many people see gold hitting new highs and think they've missed the boat. When a currency gets weaker, gold tends to rise. When inflation stays high, gold rises. When government debt spirals out of control, gold rises. But right now, we don't just have one of these things happening. We have all three hitting us at once. On top of that, add in growing geopolitical tensions, persistent supply chain issues, and a global move away from the US dollar. When all these factors combine, the market doesn't just go up a little bit. It breaks out into a completely new price territory. And folks, we are entering that new territory right now. Gold's current behavior is mirroring what we've seen before, every major financial reset in history, but this time, it's amplified by the sheer scale of modern debt. See, unlike in previous cycles, the global debt load today is so enormous that even tiny increases in interest rates risk blowing up entire sectors of the economy. This is precisely why the Federal Reserve is getting ready to pivot and start cutting rates. They simply can't keep rates this high without triggering a wave of defaults across corporate, consumer, and even government debt. And here's the crucial part. Once those rate cuts begin, real interest rates will drop. And historically, that's when gold absolutely explodes. This pattern is incredibly consistent over decades. In every single major rate-cutting cycle, gold has outperformed stocks, bonds, and cash. The central banks know this better than anyone. That's why they are quietly buying up gold before the pivot officially happens. Their buying isn't speculative, it's defensive. Think about it. When the very institutions designed to manage and support our fiat currency system start hedging with physical gold, what are they signaling? They're signaling a fundamental weakness in the system itself. Usually, the average person, the retail investor, only realizes this when it's far too late. But right now, something unusual is happening. Gold is breaking all-time highs without any of the typical mainstream media hype. There's no retail buying frenzy, no speculative euphoria you'd normally see. And that is exactly how major monetary transitions begin. They start quietly, driven by smart, institutional money accumulating assets before the public wakes up. The real acceleration, the parabolic move, happens when the general public finally catches on and rushes in. The second major driver here is supply, and this is something most people completely overlook. Gold mine production has peaked. It's a fact. Global output has been flat or even declining for years now. The world's major mines are getting older. New world-class discoveries are becoming incredibly rare, and the quality of the ore being pulled from the ground is falling. At the same time, demand is surging, especially from central banks and the rapidly growing economies in the East. This creates a simple but powerful imbalance: less supply, more demand, and a monetary environment that heavily favors hard assets. In financial markets, these kinds of imbalances don't stay quiet for long. They express themselves, often violently, through price. This is a key reason why many serious analysts believe that $4,200 an ounce isn't even close to the final high for gold. A true reset-driven revaluation could push gold to levels that most people, today, would dismiss as completely impossible. But let's talk about the heart of the matter, because this is the core of everything: the US dollar. The US national debt is now over $36 trillion. That's not just a number on a screen. It's a direct signal that the currency backing that debt is becoming more diluted and more fragile every single day. This debt can never be truly paid down in the traditional sense. It can only be inflated away. And inflation is just a form of stealth default on that debt. It's a tax on your savings. As a currency loses its purchasing power, gold inherently gains it. It's a mathematical certainty. Other countries are watching this unfold, and they know what it means. That's why they are actively reducing their holdings of US dollars. The end of dollar dominance doesn't happen overnight in a sudden crash. It happens slowly, and then all at once. It fades through thousands of small individual decisions being made all over the world. Central banks reducing their dollar reserves, countries shifting trade to other currencies, new settlement systems being built, and a global scramble to accumulate physical gold. This is happening right now. This is how a global reset begins. Let's look at history. Think about the years 1933, 1971, and 2008. These aren't just random dates. They were critical turning points where the monetary system was forced to adapt to a new reality. In 1933, the US government officially revalued gold upward to stabilize a collapsing banking system. In 1971, the US broke the dollar's final link to gold because it could no longer honor its promise to redeem dollars for a fixed amount of gold. And in 2008, the entire global financial system nearly imploded and required trillions of dollars in emergency liquidity injections just to stay afloat. Each time, gold surged. Why? Because each of these events represented a fundamental loss of trust in the stability of fiat currency. Today, the conditions are dramatically larger in scale. The debt is bigger, the inflationary pressures are stronger, and the geopolitical divisions are wider than ever before. This means the next shift isn't going to be a small adjustment. It's likely to be a structural reset of the entire system. So, what could be the trigger? It could be anything. A major government bond crisis, a series of bank failures, a sudden credit event, a global liquidity shortage, or a geopolitical shock. The specific trigger is unpredictable, but the outcome is not. Historically, whenever trust in the financial system collapses, fiat currencies weaken, inflation rises, people's savings lose purchasing power, and gold becomes the ultimate asset of last resort. This isn't speculation. It's a recurring pattern we've seen across civilizations for thousands of years. So the real question is, how is the smart money positioning for this right now? They're quietly diversifying out of overvalued debt markets. They're increasing their exposure to real, tangible assets. They're reducing their currency risk, and they are building positions in gold and silver. And let's not forget about silver. Silver often lags behind gold in the early stages, but then it tends to accelerate dramatically during these monetary transitions, often providing even greater percentage returns. Historically, both precious metals have been the top performers during periods of falling real interest rates and systemic stress. And we are entering exactly that environment. This is why gold's breakout past $4,200 is so significant. It's not just another rally, it's a signal. It's a powerful signal that the world is actively preparing for the next phase of the financial system. The people who understand history, who study the patterns, and who follow the data aren't questioning whether a reset is coming. They are asking how to position themselves before it arrives. Because in every major monetary shift throughout history, the people who prepared early were the ones who protected and grew their wealth. The people who ignored the warning signs paid the price. If you found this breakdown valuable, make sure you're subscribed. There's so much more to cover. The reset will not be televised, but the data will tell you everything you need to know if you just know how to read it. Thanks for watching.